Welcome to Investor Watch with James Ulrich. I'm your host, James, and today we discuss the hedge fund losses in the biotech industry. With many people assuming biotech investors made big returns during the pandemic, perhaps nothing could be further from the truth. Recently, the Wall Street Journal reported that the performance of the biotech sector this year is worse than all 11 of the S&P 500 sectors, as biotech stock prices overall have fallen after 2019 and 2020 surges. While some companies were winners, most have missed out on the opportunity to monetize a pandemic. Looming questions and issues mount as potential investors are spooked, which of course can adversely impact share prices. So do these notable losses in hedge funds introduce more risk or opportunity? Wall Street Journal writers Gregory Zuckerman and Juliet Chung reported on a number of negative market moves in the biotech space. All sorts of drivers could be relevant, such as the urge for Congress to cap pricing. With a surplus of early-stage biotech shares fueling at least a temporary IPO boom, losses are mounting for some players. Perceptive Advisors, a company with about $9 million under management, reports main fund losses around 30% through November. OrbiMed Partners, the $18 billion company, reports that one of their hedge funds lost over 40%, and San Francisco-based Logos Capital reported losses of 25%. Cormorant Asset Management may have been hit the hardest, with double-digit losses coming earlier this year and now reporting a further loss of even more 10%. Of course, fortunes have been made in life sciences research during the pandemic. Moderna has had a meteoric rise, including hundreds of millions earned by executives based on stock gains. Biotech's founders became billionaires during the pandemic. Pfizer reports that it could generate nearly $100 billion in the first 2 years monetizing the pandemic, with a vaccine co-developed with Biotech. Gilead generated nearly $3 billion from remdesivir sales. The early onset COVID-19 early care market for antivirals could represent as much as $10 billion per year, leaving Merck, Pfizer, and potentially others stand to benefit. Some material trends for forthcoming challenges are as follows. There could be legislative efforts to lower prices and rein in on drug companies. There is a surplus of IPOs in biotech, about 91, which is nearly double the annual industry average of 46, based on data from Dealogic. Most of those trials haven't started or are just in early stages. Safety scares have popped up, such as deaths in gene therapy studies, and vaccine safety events could dramatically spook the market should that topic become more mainstream. Some look at the upside of biotech investment prospects, declaring that the prospective COVID-19 therapies could find success in clinical trials and hence spur more IPO activity. Some trends identify a burst of buying after declines like this. So for Investor Watch, this is James Ulrich, and I'll see you in the next episode.